Welcome back to Business Report Weekly, where we dig into the headlines that you as a business owner care about the most. Today, we've got some failures, an outdated industry, and then some bold business moves to wrap it up. So let's get into it. To kick it off, the bank crashes are continuing, with First Republic Bank failing on Monday the 1st. And it's another story of a bank who targeted wealthy customers who had a large amount of deposits that weren't FDIC insured, making them much more hasty to get their money out before everything burned to the ground. It seems like a story that's on repeat right now. A large regional bank that wanted wealthy customers used great deals on interest rates to lure them in, and it worked. Many wealthy entrepreneurs, businessmen, and investors use the bank to store their wealth. And as the story always goes, it was a perfect plan until it wasn't. In January, the bank released their 22 Q4 report, which actually came in stronger than expected, except for one giant red flag. Their interest expenses, or what they have to pay for the money that they then loan to their customers, had risen a whopping 2,000%. But this was largely overlooked, with the stock actually going up nearly 10% that month after the release of that report. But then, on March 8, everything started to fall to pieces. Silvergate Capital closed their doors due to insolvency, and the news of Silicon Valley Bank struggles were revealed. March 8 was a day of mass panic. The stocks of banks that seemed risky started falling, and customers started transferring their money out of their accounts as quickly as possible. Many even believed this would mark the beginning of the end of the US economy. Not a great day to own a bank. The week following March 8, First Republic stock fell by 73%. And all of their wealthy customers who had a vast amount of money, unprotected by FDIC, did everything they could to get their money out of those accounts. And these trends continued. Between March 8 and May 1st, when the feds ultimately closed First Republic stores, their stock dropped from $115 to $3.51, a 97% drop. And it's estimated that customers withdrew around $100 billion, which was over half of their total deposits in that time frame. Yikes! Couple all of that with a year of consistently rising interest rates and the fact that they were known for offering customers great deals on interest, which gave them even tighter margins. Well, essentially, you have the perfect recipe for a bank failure. Now, if you happen to have money with First Republic, you should be able to access it now, as JP Morgan came to the rescue and purchased First Republic, guaranteeing all of their deposits. So there you have it, the perfect recipe for a bank failure. And you know that one ingredient, the rising interest rates that are behind all of this? The feds just said, let's add a bit more of that ingredient, when on Wednesday the 3rd, they opted to do another quarter-point interest rate raise. Now, I'm not pretending to know whether there will be more bank failures or not, but please, if you have bank accounts over the $250,000 FDIC insured mark, especially if they're in regional banks, just diversify. I really don't want you to lose your money because of someone else's foolishness. But now there's another industry in trouble: late night shows. Late night shows have already been struggling as they've failed to attract younger generations into that more produced corporate entertainment. And now their writers are on strike, forcing them to air reruns until they are able to get those issues sorted out. One of the main disagreements is over compensation from streaming, as even TV shows are being watched more and more on streaming platforms instead of via television. And I think all of this points back to the ultimate reason late night TV is failing: the fact that it can't exist without a bunch of writers. And listen, I get it. It has to be a grind to put out a 30-minute show every night. But today we have YouTube and TikTok, and we'd at least like to believe that we're getting authentic thoughts from those who entertain us, rather than something put together by a room full of writers who only care about whether or not their material is chosen to be on air. And to make it worse, even then, it has to be passed through legal and corporate, who definitely have no sense of humor. If late night wants to survive, they need to start looking for hosts that at least feel authentic, probably mirroring more of a YouTuber's relationship with the audience versus the typical TV star that's just great at reading a teleprompter. And speaking of TV stars, we've been saving the juiciest news for last. Let's talk about that $100 million offer. Last week, we covered Tucker Carlson being fired from the Fox News network and how bold of a decision it is to let go of your top star. Well, apparently it's not just Fox making bold moves. In the days following Carlson's firing, several people jumped to make him an offer, including Newsmax, the MyPillow CEO Mike Lindell, and Russian state media. I know, that sentence just kept getting weirder. But now there's a new horse in the race, and they seem intent on making a splash out of it. That is Patrick Bet-David and his media company, Valuetainment. On Tuesday, the offer was announced publicly on the Valuetainment social media pages, with many of the Valuetainment hosts sharing the post to their socials, often with the tag, "We are beyond serious." The offer consisted of $100 million over 5 years, plus an undisclosed amount of equity in Valuetainment, and the support to pretty much create whatever Tucker Carlson wants to create in this new career. Valuetainment is a smaller, up-and-coming media company, leaning mostly conservative, and landing a personality like Carlson would be a huge move for them. Many wondered if they can afford the offer, and of course no one knows the financials of Valuetainment as it's a private company. But from what they have said, the $20 million a year would be doable for them without having to dip into Patrick Bet-David's personal wealth. Now, how does this offer stack up against Carlson's previous salary? Carlson was most commonly assumed to receive between $15 and $20 million a year, with one estimation as high as $35 million, so it looks like this offer could be in the ballpark. Now, in other headlines, a cockroach walked the red carpet at the Met Gala, proving that no matter how rich, famous, or snobby you get, you'll always have to deal with an occasional cockroach. Also, Russia says 2 drones hit the Kremlin on Wednesday, which is probably not a step in the direction of world peace. And media company Vice seems to be headed for bankruptcy despite hundreds of millions in revenue. I'm looking forward to covering that story more in depth next week, as more details continue to come out around the situation. So subscribe, and I'll see you next week.